Why are you still investing in real estate when interest rates have skyrocketed? This is a question I get often from people and one that I want to address in today's video. So everybody's seen the headlines about the Federal Reserve continuing to push rates higher and higher. It's actually historically the most aggressive hikes we've ever seen in such a short period of time. And that leads many people to think that the economy might break in the next 12 to 18 months. That can be a topic for a different time. But naturally, this also leads people to wonder how real estate can make sense in this environment, which is a totally fair question. First, you have to keep in mind that investing in real estate is not stock trading. We're not buying today to sell tomorrow. For most people, real estate's a longer-term game, and it should be a longer-term game because that's what investing is. The multifamily deal I'm involved in now, for example, has 7-year fixed debt, which is conservative financing versus some of the other products that we've seen over the past few years. A fixed rate for a longer time horizon allows us to underwrite the deal with those fixed terms in the model and project returns accordingly. And because a mortgage is by far the largest ongoing expense in a real estate investment, for the next 7 years, we now know precisely what our biggest expense is at the property on an ongoing basis. The two rules to abide by when investing in real estate is 1, service your debt. Have ample cash flow to pay your lender and avoid foreclosure. The second is don't be forced to sell. This is often called maturity risk. The solve for this is locking in longer term debt because it's much riskier to have a 3-year bridge loan come due in the near term than it is a 7-year horizon where we have the opportunity to grow NOI and wait on strong market conditions to sell back into. My personal philosophy is that if it makes sense on paper today, then buy it. I'm not in the business of trying to speculate on the state of the world or economy in the next few years. And if I was, I'd probably always be on the sidelines simply due to how much pessimism is always out there. Nobody has a crystal ball, even though sometimes it sounds like they do. The last thing I'll say on interest rates is that when you buy with a high interest rate and they go up, great job, you just locked in a good interest rate. If the rates decline and money's cheap again, just refinance the loan. Not only can you refinance in that situation, but your asset value might actually increase due to propped up demand. On the topic of declining interest rates, as it relates to today, I know I just mentioned that nobody has a crystal ball, nobody can predict the future, this is all true, but I'm also not blind to the fact that throughout history, the longest period of time the Fed has ever went from their first rate hike to their first rate cut is 2 years. And if you look at this graph, you can see what happens when times get tough. Dramatic cuts in the early 2000s following the dot-com bubble, more cuts following the financial crisis in 2008, and finally during COVID, the Fed brought rates all the way down to 0. So while I'm not betting the house on this, it wouldn't surprise me to see declining rates in the next year or two. So those are some of my thoughts on interest rates and how it relates to the environment we're in today. I think there's a lot of pessimism out there, which in many respects is justified, but that doesn't mean deals can't get done. I'd love to hear your thoughts on the topic. Let me know if you agree or disagree with my perspective and whether or not you're still a buyer in this market. Thanks, and we'll catch you on the next one.